Hello, good evening and welcome to this wonderful session on financial reporting. The current topic is Schedule 3 Division 2. Some recent changes which has happened. So we are discussing that point. So please come to compliance with number of layers of companies. Have you done everything before that? Registration of charges. Okay, so we'll take registration of charges. Registration of charges or satisfaction with registrar of companies. So this some small disclosure is required, not very important, where any charges or satisfaction are yet to be registered with the registrar of the companies. So have you studied about charges in the company's law? So you have to get this registered with the registrar of the companies, and if it is not yet registered beyond the statutory period, then the company will have to give a detail and reason thereof. So I don't think they are going to ask you or test you on this. This is important because in our chapter Ind AS 110 we are going to discuss about layer of subsidiaries. How many layers are allowed now? Parent company, under that you can have 2 layers of subsidiaries, and if you have more than that, then disclosures will be required. That is compliance with number of layers of companies. So where the company has not complied with the number of layers prescribed under clause 87 of section 2 of the Act, read with company's restriction on number of layers rule 2017. So basically when you have got more than 2 layers of subsidiaries, then you have to give following disclosures. What are the disclosure requirement? The name and the CIN of the companies beyond the specified layer. So name of that company, suppose A, B, C, D. So this D is beyond the specified layer. Name of this company D, and CIN. I don't know what is CIN. Company identification number. That's good. So every company nowadays have got that company identification number. DIN is the director's identification number. TIN is what? Income tax. Taxpayer identification number. TIN or TAN? 10 is different. Anyway, that is not my subject. So company identification number will have to be given, and relationship or extent of holding of the company in such downstream companies shall be disclosed. So how many shares A is holding in D? What is the relationship between these two companies? All this will be disclosed, because you are violating this rule, company's restriction on number of layer rules. If there are too many layers of the companies, it becomes very difficult to track the activity of the company. You are the investor, you will invest in A will invest in B, B in C, C in D, D in E. So we really don't know where is my fund, and sometimes they are located in different countries also. So that leads to a lot of activities which should not have happened. Okay, this you must have read in that Adani saga, is it right? Hindenburg report. So many layers they create, and it is very difficult to identify from where the funds are coming. So same money is getting rotated and invested in the listed company, and the share prices are artificially boosted. Possible? Yes. So now the government will have at least some idea about from where that money is coming in. One good thing they have done is that now companies will have to disclose certain ratios, which was not there in the earlier case. So therefore, you as a chartered accountant or a financial expert, you have to know the ratios now. You have to teach other people also these ratios so that they can read the balance sheet and understand the performance of the company, liquidity, risk involved, okay, long-term growth involved, etc. So which are the ratios you have to disclose? Current ratio, debt equity ratio, debt service coverage ratio, return on equity, all the important ratios, inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment. If you look at these are really good ratios. Of course, you can suggest that they should have added few more ratios. That list is endless. We had a topic in FM, ratio analysis, and almost 40-50 ratios you have studied. Okay, so out of that, the key ratios, like for example, current ratio helps in understanding liquidity, debt equity ratio, understanding risk, debt service coverage ratio, whether company can pay the interest and installment out of this profit or not. And of course, as an investor, we want to know how much return we are earning on our equity investment. This inventory turnover ratio, trade receivable, these are working capital ratios. How the company is managing its working capital, what is the liquidity, okay, what is the utilization of the resources, all this you get to know. Same thing for turnover ratio. And this net profit ratio, return on capital, return on investment is the efficiency, performance. So all these ratios are required by the investors to take the decisions whether to invest in a company or not. Then not only that, for people who are not from the finance background, they have added one more line. Companies are also required to explain the item included in the numerator and denominator. So they have to write down in numerator what is written, like in current ratio, which all current asset item they have included, which all current liability they have included for computing the above ratio. Otherwise, again, you can fool the people by putting something or not putting something, right? And if there is any change by more than 20% compared to last year, then that also have to be explained. So if current ratio was 2 and suppose this year it becomes 2.50 or 1.50, so the change is more than 25%, to disclose why this change has happened. Now matters which require consideration on ratios. So these are some opinion we have added. The above requirement for disclosure of key ratios is welcome. Welcome for better understanding and analysis of financial statement. It's not there. This is just a commentary, you can just ignore it, not required. Is it there, cash flow? I have also in the previous slide added the commentary, but not required. It's not a part of the schedule 3 division 2. So let us go to next 22 number paragraph, cash flow related ratios, ratio derived from cash flow statement of the company. There are two important statements company prepares. One is statement of profit and loss and one is statement of cash flow. In Ind AS we call it statement of cash flow. In accounting standard we used to call it cash flow statement. Profit and loss account is prepared on accrual basis, but cash flow statement is prepared on actual inflow and outflow of cash. It has been observed that companies are showing higher profit, but they don't have enough cash flow. So now the company also will have to give some ratios relating to cash flows, like current cash debt ratio or cash coverage ratio, that is net cash flow from operating activity divided by average current liability, whether your cash flow from operating activity is sufficient to pay your current liabilities. So that ratio will help us to check ability of the firm to pay its current liabilities out of the cash flow generated from operating activities. Then cash flow coverage ratio, which means cash flow from operation divided by total debt, which measure the solvency of the company, that is ability of the company to pay the total debts. These ratios are really important for understanding the solvency of the firm. Can the company pay its debt on time or not? Is it right? Company can pay debt only if it generates cash. And it is always better to generate cash flow from operation to make payment of your liability, not borrowing from one source and paying the other one. So these ratios communicate the effectiveness of a business operation and demonstrate the solvency. Whether company will be able to survive in the long run or not, whether it will be able to pay its long-term and short-term debts or not. Next point is compliance with approved scheme of arrangement. So this is related to your company's law arrangement, section 230 to 237, when company go for some kind of restructuring. So where any scheme of arrangement have been approved by the competent authority as per section 230 to 237. So what are the disclosure requirement? Again, not very important because it's more of a legal compliance. Company will disclose that the effect of such scheme of arrangement have been accounted for in the books of account as per the scheme. Okay, so that means in the scheme usually they mention how the scheme will be given effect in the books of account. So you have to mention whether the scheme have been complied or not, that it has been complied as per the applicable accounting standard. If there is any deviation from the scheme of arrangement agreed, that will have to be explained. Now next is additional disclosure in notes to P&L account. Very dangerous item coming now. Hold your breath. Undisclosed income. Undisclosed income means reconciliation of income tax in Companies Act. I have not seen any company disclosing that, but again let us see. As time will pass, we will understand. Companies will give details of any transaction not recorded in the books but has been surrendered or disclosed as income during the tax assessment. So what will be the effect of this? This will also affect my another standard Ind AS 8, which has one item, prior period item. After some days we will discuss, because if you have not disclosed any income and now you are disclosing, it means it is not this year mistake, it is a mistake of previous year or previous years, and therefore it will require retrospective application, and one additional balance sheet will have to be prepared. Because if you are saying yourself that I have not disclosed income, means it is an error or omission. Error or omission will have a retrospective adjustment. Okay. So what are the disclosure you have to give unless there is an immunity for disclosure under any scheme? If government says okay, you have an immunity from disclosure, don't disclose, then enjoy. Otherwise you have to state whether the previously unrecorded income and related assets have been properly recorded in the books of account during the year. Disclosure of the above information. Now government said you disclose undisclosed income, but how as a user you will look into this aspect? You will be happy to note that your company is earning so much income and we are not aware about it, or you will doubt on the integrity of the management. You will doubt on the financial statement that you were reading so far. You don't know whether last year was right, wrong, at least. So this will help them to understand the impact of undisclosed income, and also to understand and evaluate the appropriate recognition of undisclosed income in the financial statement of the company. That is, to what extent your income has got affected in the earlier year, current year, and what will be the tax implication of that. In fact, you don't have to not, you have to pay tax plus penalty and some interest, etc. also, and it will really put question mark on the integrity of the management. Disclosing such income means getting further money from investors will become very difficult. Okay, nobody would like to invest in a company which have got undisclosed income. Then we will discuss CSR disclosure. What is the full form of CSR? Corporate Social Responsibility. Which section of the Companies Act deal with that? Section 135. And now companies have to mandatorily transfer some percentage, 2% of their net profit, average net profit, okay, for CSR activities. Government is saying you are earning so much, why don't you contribute something towards the society also? So either you can contribute directly, do some activity directly, or you can do it through some other organization. And if you can't do anything, then Prime Minister, some fund is there, na? Yes, you can give. That is also part of CSR expenditure. Prime Minister Relief Fund and so many funds they have specified. So where you can invest, and that will be treated as amount spent for CSR activity. So disclosure requirement are, first you have to disclose how much amount is required to be spent. So there is a formula in the Companies Act, 2% of your net profit, average net profit, and then you have to check how much you have actually incurred, and if there is a shortfall you have to disclose. Then any total of previous year shortfall you have to disclose, reason for shortfall, and then what are the nature of CSR activities you have undertaken. You have to give a brief disclosure of that. And if there is a related party transaction, so you can have your own NGO also through which you can contribute. That means you can just transfer money from company to your related party NGO. That is what happens. Is it right? Don't write anywhere. The purpose of bringing this section is that now you can give donation officially to all these NGOs managed by political parties. Is it right? And then they will again use that money for some election funding or something, but that is not to be mentioned anywhere. Details of related party disclosure, and they are forcing you to make that payment. It's requirement. So you have to disclose any payment to related party, contribution to a trust controlled by the company in relation to CSR expenditure as per the relevant accounting standard. So that is now an official channel to siphon of the funds from the company. So in some cases, not every time. Where a provision is made with respect to a liability incurred by entering into a contractual obligation, the movement in provision during the year will be disclosed. So if you have created any provision, movement, opening, addition, deduction and closing balance with respect to that provision will be disclosed. And one more paragraph I will discuss is details of cryptocurrency or virtual currency you have to disclose. This area is a grey area in India. There is no legal clarity on this. Is it right? Because RBI tried to ban cryptocurrency, but I think Supreme Court said no, you can enter into this transaction, but there are regulations. We are not interested in that right now. If the company enters into transactions relating to cryptocurrency or virtual currency, some example of cryptocurrency on the right side, some of them don't exist also anymore. They have got wound up and investors' money have gone into water. Is it right? Some value was $30-40 and it became $0.01 or something. So have you played in cryptocurrency any time? No. Very good. So Bitcoin is the most popular one, and then because of that some other came: Ripple, Litecoin, BitShares, Stratis, Dogecoin, Zcash, etc. Okay. We don't know what is this item. Is it right? Whether it is a intangible asset or financial asset or a derivative, because there is no underlying. It is just based on demand supply. You are playing with that. So you will sell to B, B will sell to C, C will sell to D, and the amount will keep on increasing, and finally the last person will be holding it. Is it right? Anyway, so what companies have to do, if they have traded or invested in cryptocurrency or virtual currency during the financial year, the following will be disclosed. So let your user also know that your P&L account contains profit made out of cryptocurrency. Business is to sell steel, and P&L account contains profit from transaction in cryptocurrency. So then the investor will ask you the question mark, that is it the purpose for which the company was formed? So profit or loss on transaction involving crypto or virtual currency, an amount of currency held on the reporting date. So you have to also specify how much cryptocurrency you are holding, and if you have received deposit or advance from any person for the purpose of trading or investing in cryptocurrency, even that will be disclosed. So let your user know that you are doing this activity also. Right, wrong is a very debatable issue. Okay. One homework you will do today, you will read the annexure A, which is the bare text of division 2, plus one more homework I had given earlier. You will read the guidance note on schedule 3 on page number 2.13. Just have a quick reading of it. The question which you can expect in the exam would be a numerical question where you will be required to prepare balance sheet, SOCI, statement of profit and loss, notes to account, or maybe based on some recent amendment they can ask you some question. Okay, but beyond that usually they don't ask question from this topic. Is it right? Okay, please come to Ind AS 1. What is the standard Ind AS 1? This is the first standard we are doing. Ind AS 1, presentation of financial statement. This standard is very close to schedule 3 division 2, but that schedule 3 division 2 is given by the Law Companies Act, and this is a part of Ind AS. It is inspired from IFRS, that is IAS 1. The name of IAS 1 is also presentation of financial statement. In this standard you will learn that what is the requirement of the presentation in financial statement. What is the purpose of financial statement? What are the important things we have to keep in mind while preparing financial statement? Is it right? So this is a very simple standard. And there was a question also on the standard in May 2023 exam, which is there already in the notes, right? So very easy standard. Welcome to Ind AS 1. First question is, what are Indian accounting standard? What are Indian accounting standards? So different people will give different answers. You will say Indian accounting standards are converged version of IFRS. But as per this standard, Ind AS has been defined. It means these are the standard prescribed under section 133 of the Companies Act. So legally speaking, the definition is these are the standard prescribed under section 133 of the Companies Act. But in general, if somebody asks you that these are the Indian version of IFRS, and we have given it a name Ind AS, so that it will indicate these are Indian version of IFRS. And what does Ind AS 1 deal with? Does it deal with property, plant, equipment, or inventory, or employee benefit, or financial instrument? The answer is, it simply deals with, first, what is the meaning of financial statement, then what are the overall consideration in preparation and presentation of financial statement, what are the elements of financial statement, and then structure and content, which is addressed by division 2 of schedule 3. So you will find you have studied lot of things already in division 2 of schedule 3, but this is a standard, so we have to go through it. Now if somebody asks you, you go home today and your small young brother asks you, what do you mean by financial statement? You are a CA, what is financial statement? What is financial statement? Yes, reply. Financial statement means balance sheet, notes to account, profit and loss account, cash flow statement. He is an 8th standard student and you are bombarding him with cash flow statement, notes to account. Do you think he will understand? So therefore, financial statements are basically a structured presentation, means a standard format of the financial position and financial performance of the entity. Then your brother will ask you, Bhaiya, what is financial position? So financial position means summary of your assets, liabilities and equity on a given date. Then he will ask, what is financial performance? So it is a statement showing how much profit or loss you have earned during a reporting period and how much cash flow you have generated from operating activity, investing activity, financial activity during a period. So it shows you basically that financial statement are basically going to disclose two things: financial position, which is balance sheet, and financial performance, which is your statement of profit and loss, statement of cash flow. What is the purpose of preparing financial statement? We are talking from investor's point of view. One answer can be financial statement is used for preparing tax return. Ind AS does not ask you to prepare financial statement for filing tax return, because for tax purpose you have to calculate tax liability as per their format, their requirement. But this is basically for investors. Ind AS, IFRS are basically for whom? For the investor who take economic decisions based on the financial statement. So who are these people who take economic decisions based on the financial statement? Who are these people? The investor, present and potential, the lenders, is it right? The government sometimes, the management, creditors, debtors, even the employees. You would like to work in a company which has got lot of profit, lot of cash flow, so that they can pay you salary on time and they can give you lot of bonus also. That is why many students join Big 4 firm, overloaded with profit. Is it right? And they give huge bonus also. Sometimes the bonus is more than the salary for the year if they crack some good deals. So that is the purpose of financial statement, and this objective can be met if the company prepares a complete set of financial statement. Then your query, what is complete set of financial statement? So it means balance sheet, statement of profit and loss, SOCI, notes, cash flow statement, additional balance sheet if required. Okay, so all this together will form complete set of financial statement. Financial statement can be consolidated or separate or standalone financial statement. Ind AS requires you to prepare consolidated financial statement for the group if you have a subsidiary. Okay. Of course, there are some exemptions, but in general, if you have a subsidiary or if you are a parent company of a subsidiary, then you are required to prepare consolidated financial statement of the group. There are some exemptions given to certain companies. We will see in Ind AS 110. Then the companies have to also prepare. In India, both statements are prepared. If you see the annual report, it will contain standalone, that is separate financial statement only for the entity, and it will also contain consolidated financial statement if there is a subsidiary. And what information do you get from financial statement? Financial statement helps us to understand what are the assets of the company. So there is an asset side which will give you all the assets held by the company on the reporting date. Is it right? So you can analyze how much is property, plant, equipment, how much is financial asset, how much is inventory, how much is cash they are carrying. Then it also gives you all the liabilities of the company on a given date, divided into non-current liability, current liability, provisions. Then it gives you information about equity, that is owner's money. How much is the amount invested by the owners in the company. Then statement of profit and loss gives you information about income of the company, and statement of cash flow gives you information about cash flow. And there is also in the notes to account they give additional disclosures, so that also you can mention. So what are the components of financial statement as per Ind AS? Most of these you already know. One is called balance sheet, then statement of profit and loss with OCI, other comprehensive income. You have to also give statement of changes in equity if it is an Ind AS balance sheet, statement of cash flow, notes to account, and in some cases additional balance sheet. If you apply accounting policy retrospectively, additional balance sheet. If you do rectification of error, additional balance sheet. And when you adopt Ind AS for the first time, that time also one additional balance sheet is required. So on 3 occasions additional balance sheet is required. If suppose you go for interview and they ask you this question, when are you supposed to present additional balance sheet? So your answer will be when a company adopts Ind AS for the first time, when there is a retrospective application of accounting policy, and retrospective rectification of prior period item. Other than these 3 there is no, unless some standard tells you, some transition provision tells you otherwise. Okay. Financial statements are prepared for profit as well as not for profit organization. Even a not for profit organization, if it falls under Ind AS applicability, like section 8 company, but net worth is more than 250 crore, can apply Ind AS. So they also have to prepare financial statement with suitable changes. Next important point is What is general purpose financial statement? Now tell me, suppose you go to take a bank loan. Okay, bank says you give me the data in this format. They have their own format, okay, so that their system will be able to evaluate whether you need to be given loan or not. Their software will pick up the data and do the ratio calculation and take the decision. Or for example, there is an investor who wants to invest in your company, but he says, I want the financial statement in this format. Or government says, you have to give me information in this format for any tax or subsidy or whatever. Are those general purpose financial statement? They are special purpose. Is Ind AS applicable to such financial statement? The answer is no. Or you prepare budgets. The CEO says, I want the information in this format so that I can allocate resources and take decision. Is that general purpose financial statement? The answer is no. So general purpose financial statement means those financial statement which are intended to meet the needs of user who are not in a position to require an entity to prepare reports tailored to their particular information need. So they are not customized statement. The same format can be given to investor, potential shareholder, banker, customer. That is general purpose financial statement. It is prepared as per Ind AS, not customized for any particular group or particular person. So now next is, before I proceed further, I want to discuss some terms that will be used in this standard. Like for example, there is a term called impracticable. What is the meaning of impracticable? Which is not practically possible. Example, you have to score 900 marks in CA final. Practically, okay, you have to score 600 marks out of 600. Impractical. Or you have to study 22 hours per day till exam date. Practical. No, why? What is the problem? 22 hours you can study out of 24. For 1 or 2 days it is possible, but after that you will be hospitalized. Correct. So that is impracticable. Even though you try hard, after 2-3 days you will not be able to manage. You will start feeling sleepy. So why we are discussing impracticability in Ind AS? Lot of adjustments have to be done retrospectively. Lot of disclosures are required to be given. For lot of items, fair value have to be calculated. Right? Now, management may not have data to do retrospective application, may not have necessary trained staff to do the retrospective application, may not have resource to hire consultants to do that retrospective application or apply Ind AS the way they want. Then in that case you are given some relaxation, at some places some disclosures will be given. Okay, if you say that no, you have to do everything as we want, some management will not be able to do it. So impractical means applying a requirement is impracticable when the entity cannot apply it after making every reasonable effort to do so. A very subjective line. Management will tell the auditor that, see boss, I can't apply it. I have tried very hard and I don't have so much of resources to do it. So you have to demonstrate to the auditor that yes, we have tried very hard. Okay. And similarly, there is one more concept called material. When you were in 12th standard small student or in foundation, they used to make you remember one line by heart one line. Material means the knowledge of which might influence the decision of the users of the financial statement. that is materiality, knowledge of some financial information. If you have that information, you may take one decision. If you don't have that information, you might take another decision. So such financial information are called material financial information. So the definition of materiality, they have changed slightly, although the crux remains the same, the concept remains the same, but they have elaborated, they have increased the scope of this word material, right? Management would try to hide information if they can. Management will try to confuse the users if possible. How do they confuse? They will spread the information in several places instead of giving at one place. Sometimes they give unnecessary information. Too much of information will confuse you. Is it right? Like there was a serial Money Heist. I don't know you have seen it or not on Netflix. You have seen. This is your job to watch this serial, or you should study. I am surprised. You are investing your time in this kind of serial instead of revising. So I remember one scene in that one lady goes to that court and she keeps on giving information for 24 hours. How that heist was planned, what they will do, and the judges also start sleeping after some time. So the idea was to pass the time by giving lot of irrelevant information continuously so that they lose the track of what is relevant out of it. Our Indian management also tries to do that. Okay. And in the process you will forget what is important and what is not important. Like the EIS teachers used to do, okay, in intermediate. In 3-hour lecture you were wondering exactly what was relevant in this discussion. So information is material if, so now they have defined it, if omitting means just not giving that information. Like the Schedule 3 says you have to give disclosure about Benami properties, give disclosure about undisclosed income, and you omitted it. So don't you think that will affect the decision maker? Had you known that this company has undisclosed income, I would not have invested my money. Or misstating, wrong information presented wrongly, misstatement. So maybe you will have a financial asset, but you might present it as a non-financial asset. Instead of putting it under financial asset category, you might put it as a non-financial asset category. You can do that kind of thing. Or obscuring in bracket, right, hiding. I have written it for you. Obscuring means hiding. You will be putting it in the financial statement, but in such a manner that it's not easily understandable by the users. You will aggregate it with some item. Like it happens in related party disclosures. They don't give 100% related party disclosure, so they just try to hide that kind of information. Okay, because if you have related party information and where the company has not entered into an arm's length transaction possible, then they would try to hide that kind of information. That is obscuring. You will also do it once you become CEO, okay, don't laugh. That is what is trained in your articleship. Okay. It could reasonably be expected to influence decision that primary users of general purpose financial statement make on the basis of those financial statement. So if information is omitted, misstated, obscured, and because of that, if it can influence the financial decisions of the users, then such information is material, which provide financial information about a specific reporting entity. So example is not disclosing undisclosed income as per Schedule 3 Division 2, not disclosing Benami property disclosures, not giving age-wise breakup of capital WIB, okay, giving aggregate information instead of segregating that information where required. So that kind of information is material if it can influence the user of financial statement. So many times materiality depends on the nature, the magnitude, or both. So if there is an undisclosed income, then the fact that it is undisclosed income itself is material, okay, but sometimes the amount can be deciding factor. Like printing and stationery of 100 rupees is booked under traveling and conveyance. Is it a material information? 100 rupees printing and stationery booked under travel and conveyance. Company's turnover is 2000 crore. And in the internal audit report, you must have done in your offices, internal auditor writes, observation, 100 rupees printing and stationery booked under travel and conveyance. Company has followed wrong classification. But that kind of information is really useless, okay. But yes, if it is a 10 crore rupees invoice and it is not recorded properly, then it can be a material information, or sometime it can be both. Also, like for example, audit fees is a material item because of its nature, okay. Payment to related parties, loan to related parties are material item because of their nature. So one has to understand what is material. It requires judgment, okay. There is no hard and fast criteria, although Companies Act in general have said 1% of turnover or rupees 10 lakh, whichever is higher, will be shown separately. So you have to assess whether information is material or not, either individually or in combination with other information also. The materiality has to be judged in the light of the entire financial statement. So if I look at the whole financial statement, whether this information, this amount is material or not, that is the meaning of materiality. Now the paragraph which was added recently in this Ind AS amendment 2-3 years back is this paragraph, tick mark, because this you have not studied in your intermediate or foundation or 11th 12th class. They have added one term called obscured. Obscured means hiding the information, okay. One way to hide the information is you aggregate it with other item. Like sale of fixed asset, you may add with sale of goods and service, and then sale of fixed asset gets hidden in the profit and loss statement, okay. Sometimes giving too much information so that what is relevant gets hidden. Sometimes you spread the information over several schedules and several places. That can also be obscuring the information. Sometimes you use vague words to describe something, or sometimes use jargons, complicated language which only some people can understand. That is also obscuring the information. You will say, no, I have given, but then most public are not able to understand. In fact, they hire people to draft such kind of statements, okay. And nowadays, because of this artificial intelligence coming in, they will make it more complicated. So when is information obscured? Information is obscured means hidden when it is communicated in a way that would have a similar effect for primary users to omitting or misstating that information. So even though it may be there in the financial statement, it is as good as omission. It is as good as misstatement because it is not presented in such a manner that it can be easily understood by the users. So example I have written in your book. If they ask you, give 4 examples of obscured information. One is the language is vague or unclear, like the answer you write in audit. Okay, examiner is not able to understand what he is trying to write. More importantly, even better example, the answer you write in that EIS paper, neither you understand nor the examiner understand, and then using a coin he gives you the marks. Head 5 marks, tail 3 marks. Okay. Second is information is scattered throughout the financial statement rather than putting all the information at one place. Sometimes you try to read balance sheet of, say, like Reliance. It's so difficult to connect the dots. Okay, so much of data in such a small font. If you are reading the hard copy, okay, you will think it's very difficult. And then dissimilar items are inappropriately aggregated. Sale of goods, sale of PPE might be aggregated. This was just an example. It can be anything like that. Okay. Then similar items are inappropriately disaggregated also. Means overloading of information. You could have simply written one item, printing and stationery. So you have divided that into few lines. Purchase of books, purchase of stationery, purchase of office stationery. These are same item. Who is interested in that breakup? As a decision maker, I am not interested. Purchase of stationery, purchase of office stationery, purchase of factory stationery. Unnecessary giving lot of sales invoice data in the related party. Ind AS 24 says if the sales are same type, you can aggregate them. But to confuse the user, they will give 25 invoice data. Useless. Next is the understandability of financial statement is reduced as a result of material information being hidden by immaterial information, to the extent that primary user is unable to determine what information is material. Too much of information. If you see their notes, it's drafted in long lengthy paragraphs. Even we are qualified people, we are not able to fully understand what they are trying to write. Think about a layman who is not from the field of accountancy and finance. He will find it even more difficult, because the objective is not to give information. The objective is to hide the information. As I gave you the example of that serial, okay, Money Heist. For 2 days the story was explained to the judge, and the judge also went into sleep mode. Now come to point number 7, important definitions. So very quickly we'll go through. First definition is notes. What is notes? Notes are additional information given over and above balance sheet, statement of profit and loss, statement of cash flow, statement of changes in equity. Then the student will ask, why notes are required? Why notes are required? Everything cannot be given in the balance sheet, P&L account, cash flow statement or SOCI. There are so much other relevant information required, which are required to be separately given. Like for example, contingent liability disclosure, right? For example, related party disclosure, accounting policy disclosures, breakup of the say inventory item in the balance sheet I will write inventory, but then how much is WIP, raw material, finished goods, etc. I need to give in the notes. So in P&L account you give EPS, but then how that EPS is calculated is given in notes. Okay, so that is the idea, that if you can't disclose or present in the main financial statements like balance sheet, profit and loss, you can give the information in notes. So it contains information in addition to given in balance sheet, statement of profit and loss and statement of cash flow. The purpose is to give narrative description like accounting policies. What is the example? Accounting policy disclosure, which will give information what accounting policy they are following for various items. Then disaggregation of item like inventory, trade receivable, PPE, most of the item of balance sheet, and then those information which do not qualify for recognition in other statements like say related party disclosure. Example, related party disclosures. Then you have financial instrument related disclosure, financial instrument related disclosures, and disclosures required by other standards. Disclosures required by other standards. You will find in most of the standards at the end they will say disclosures. Where will those disclosures be given? In the notes. This will help you to understand the financial statement better, understand risk better, understand liquidity better, understand long-term solvency better. So, if you see the total number of pages dedicated for notes, it is many times more than balance sheet P&L account. And a genuine long-term investor reads the notes carefully, because there lies the devil. Okay, devil lies in the details. And if you can read the notes carefully, because when you will qualify and if you join suppose an equity research firm, first month they will ask you to just read the annual reports. They will say first understand the annual report, what they are disclosing, why they are disclosing, how it will affect the future performance of the company. Okay, how does it affect the risk of the company? And then you will decide whether to invest or not. So don't think notes are boring. Notes are also important. And in Ind AS financial statement, we have to also give other comprehensive income. Now the definition of other comprehensive income is those item of income and expense including reclassification adjustment that are not recognized in profit and loss or as required or permitted by other Ind AS. So one interesting feature of our Ind AS is in P&L account there are two parts. Part 1 profit and loss item, part 2 is other comprehensive income, which contain those items which are not included in P&L account, but these are income in nature, expense in nature. These are unintentional. The International Accounting Standard Body have defined what will be included in OCI. So here, therefore you don't have a discretion here. We'll discuss about it again after some time. Then the next is owner. Who are the owners? Owners are the owners who hold equity instrument. Then what is profit or loss? The profit or loss means total of income less expense excluding the component of OCI. So Ind AS companies will divide their profit and loss into two parts. First part is profit or loss, second part is OCI. Okay, the items which are included here are not included here, and the items which are included here are not included here. although for some item recycling is allowed when they are realized. Okay, so that again we'll discuss after some time. And next is reclassification adjustment. In OCI there are two categories of items. One we will call recyclable and second non-recyclable. Recyclable means those which will be later transferred to P&L account, like foreign exchange gain or loss on foreign subsidiary. Okay, that is recyclable. Then foreign fair value gain or loss on debt instrument classified as FVT OCI. Debt instrument classified as FVT OCI. So those can be later on transferred to P&L account, and that is called reclassification adjustment. So these are the amount reclassified to profit or loss in the current period that were recognized in OCI in the current or previous period. If the student have attended schedule 3 division 2, our previous chapter, there I had taken one problem where we have shown in OCI certain items, and then what is total comprehensive income? P&L account plus OCI is total comprehensive income. Okay, but definition says change in equity during a period resulting from transaction and other event other than those changes resulting from transaction with owners in their capacity as owner, which simply means profit and loss plus OCI. Will share issued be also included in OCI? Will dividend paid be considered as OCI item or TCI item? No, because those are transaction with the owner. So issue of share, buyback of share, share premium, bonus share issued, dividend paid will not form part of TCI because those are transaction with the owner. They also influence the equity, they also affect the net worth, but they are not part of TCI. Next question, theory question, tick mark for exam purpose. What comprises a complete set of financial statement? A complete set of financial statement will comprise of a balance sheet as at the end of the period, a statement of profit and loss for the period, a statement of changes in equity for the period, a statement of cash flow for the period, and notes which will contain a summary of significant accounting policy and other information. And this important point, a balance sheet at the beginning of the earliest comparative period when an entity applies an accounting policy retrospectively or makes a retrospective restatement in its financial statement or retrospective reclassification of item in the financial statement. This is one sentence, and that is basically you are rectifying prior period item. If there is a prior period item which is relating to restatement of item, like for example wrong calculation in the earlier years or wrong classification in earlier year, investment property was wrongly shown as PPE, now you realize, oh, I have made wrong classification, so then you have to prepare additional financial statement. So if you have made any accounting mistake, any omission, or even a wrong classification made earlier, then we have to prepare one additional balance sheet. And one more thing, when you are adopting Ind AS for the first time, that time also Ind AS 101 will require you to prepare one additional balance sheet. Is it right? Any query? All the above items should be presented with equal prominence. Means you have to use same font, same color coding, same size of the font. Okay, anyway, that line is not very important. Then many reports are presented by the management along with the financial statement by most of the entities. Just check the annual report of some company, find some time, look at the annual report. It will contain lot of information, like you will have director's report, auditor's report, management discussion and analysis. Are they also part of financial statement? They are not part of financial statement. Keep in mind, such reports or statement are not in the scope of Ind AS. Even though annual report may contain such statement and they may contain some financial information also. Like in the director's report, they will say, we have earned so much profit. Okay, profit is a financial information, but that is not covered by Ind AS. So I have made a small summary of complete set of financial statement. Quickly go through it. Complete set of financial statement will comprise of balance sheet, SOPL, SOCI, statement of cash flow, notes. Notes will basically cover accounting policies and explanatory information. Balance sheet, you have to prepare one at the end of the year. A minimum one comparative balance sheet is required to be given, minimum one, and one additional balance sheet is required to be given if there is a retrospective application of accounting policy or retrospective restatement of item or retrospective reclassification. Okay. Then come to P&L account. You will prepare one profit and loss for the current period and one comparative for the previous year. Minimum one comparative is required. Same thing for statement of change in equity, same thing for statement of cash flow. And notes will contain narrative information, description of information if it is relevant for understanding the current period's financial statement. Okay, so this is what you have to do as a company accountant. These are the statements you will have to prepare if you work in the finance department. Now note, in India we have omitted one option. What is that option we have omitted? Two statement option we have omitted. In IFRS you have a choice. What is that? You can either prepare one single statement which will cover profit and loss and OCI, or you can prepare two statements, one for profit or loss item and one for OCI. But we have only a single set which will cover part 1 profit or loss and part 2 OCI in two sections. These two sections together will be called total comprehensive income. Then this line already explained to you, if there are any statements, reports presented outside financial statement, director's report, auditor's report, CSR report, okay, management discussion and analysis. Some company also give human resource related report. Some companies give economic value added report also. Very few, but they give. Some company give value added statement report. That is voluntary, outside the scope of Ind AS. So an entity is not required to present the related notes to the opening balance sheet as at the beginning of the preceding period. So notes are not required for that additional balance sheet. Next, general knowledge question. We'll go through it quickly, but we have to solve one numerical question also here. Are you ready? Purpose of financial statement. The purpose of financial statement is to present financial position which is given by balance sheet. The purpose is to present financial performance which is given by SOPL and SOCI, and also the purpose is to give cash flow information which is given by statement of cash flow. What are the general features of financial statement? That is, when you are going to prepare the financial statement, what are the important care you will keep in mind, or the features you will include in that financial statement, and that is our main part of this chapter now. So we have to discuss about true and fair presentation, going concern, accrual, materiality and aggregation. This I have covered already. Offsetting, frequency of reporting, how much comparative data we have to give, consistency of performance, and structure and content. This is basically in our country schedule 3 division 2, structure and content. Although this standard will give you some requirements, but structure of the financial statement in India is given by division 2 of schedule 3. Ind AS 1 does not give you any format. It only gives you requirement, but the format is given by schedule 3 division 2. So that is why when you study or revise, first read schedule 3 division 2, then read this chapter, then you will find lot of connection is there. Okay. So my first requirement or first feature of a financial statement is presentation of true and fair view. Okay. Now what do you mean by true and fair view in the context of Ind AS? It means you have applied all Ind AS. Okay. The way Ind AS requires you to apply them without deviation, with all the necessary disclosures. So we will say my financial statement is true and fair if it complies with all the applicable Ind AS, with all the additional disclosures. Don't write general answer which they teach in auditing subject. In auditing also there is true and fair. Auditor must ensure that financial statement are true and fair. But what is true and fair? True and fair means it should comply with Ind AS. In totality, not selectively. Then we will say that financial statements are true and fair. And now they have put one more responsibility on the management. You have to mention at the end of the financial statement that our financial statement is Ind AS compliant. You have to give an explicit and unreserved statement. Explicit and unreserved means no disclaimer. An explicit and unreserved statement shall be made that the financial statement comply with all the requirement of Ind AS. If it deviates from the requirement of Ind AS, then you cannot write that financial statements are fully Ind AS compliant. Okay. So now there is a question number 1. If the answer is printed, we will just discuss the question. Most of the questions are taken from study material, RTP, MTP and past exam. Some extra question also have added from reference book if there is a discontinuity in the example. Okay, like there are situations where institute publication does not have any example on that, so I have added that example. An entity prepares its financial statement that contain an explicit and unreserved statement of compliance with Ind AS. So management views that our financial statement are fully Ind AS compliant. But what about auditor? The auditor's report on this financial statement contain a qualification because of disagreement on application of one accounting standard or one Ind AS. But auditor believes that one Ind AS is not fully complied with. In such case, is it acceptable for the entity to make an explicit and unreserved statement of compliance with Ind AS? Who is responsible for preparing financial statement? Management. It is a management's prerogative to decide that yes, our financial statements are fully Ind AS compliant, and they can take that stand and write in the notes. Auditor has to check whether all Ind AS were complied or not, and if not, the auditor has the discretion to qualify the report. So therefore management can go ahead and still state that my financial statement are fully Ind AS compliant, let the auditor qualify the report. So what will happen when auditor qualifies the report? The users will ask the management, the banker, the lenders, they raise a question. Qualification is not a very good thing in the financial statement. That is why the whole audit is done. So one qualification will attract lot of criticism. In fact, to some extent, if there is any loan proposal which is in the pipeline, it can get struck permanently, or okay, investor will not trust such balance sheet and P&L account. So generally they will try to come to an amicable situation. Normally, practically, when I was auditing big companies, we used to get some situation when there was a qualification, but then we'll manage amicably. Is it right? Of course, if it is of such big issue, then normally the auditor takes a strong stand, right? So these are practical issues. Usually they try to ensure that there is no disqualification. But if the management insists and the auditor does not agree, then the audit report will get qualified. But still, in the given question, we will say the company can make explicit and unreserved statement of compliance with Ind AS. Reason: the preparation of financial statement is the prerogative of the management, discretion of the management. It's the management's call. Now one more paragraph on which we can expect a question, and only if you have studied it in detail you can answer. Otherwise you will write your own Ind AS, students Ind AS. Departure from a particular requirement of Ind AS. Can you deviate from a requirement of Ind AS? Can you deviate from the requirement of Ind AS? General answer is yes, but the answer is subject to if the law permits deviation. But then the disclosure requirements are too many. Okay, because you have deviated from the requirement of Ind AS. Impracticality issue will also be checked, that you will try to apply. Second, you have to also ensure if by complying with Ind AS, it should not be misleading. By complying with Ind AS, if it can be misleading, let's say for example, there is a derivative, exotic option which does not exist, customized for you. Possible? Yes, possible. Customary, you can customize any derivative product. You and I can enter into a contract. If Virat Kohli makes 200 run in second test match, then I will give you 200 rupees. But before that year end comes, I have to value this derivative. Is there any formula to find out the value of this derivative? This is a derivative, it's a forward contract. If Virat Kohli makes 200 run in the second test match, I will give you 200 rupees. So it's a forward contract. But how do I value it? So if I value it, it will be misleading. Okay. So sometimes following Ind AS can be misleading. Then the management can deviate subject to the law also permits deviation. So that is the crux of what is mentioned in the Ind AS. In extremely rare circumstance, this is not a norm, it is a rare of the rare circumstances you are allowed to deviate if the entity finds that departure from complying with the prescription laid down in the standard will be more appropriate. And this may happen where the management concludes that complying with the requirement of Ind AS would be misleading. So lot of complex situations can arise. Court cases are there where you don't really know how to value the liability. Derivative products are there. how to value them, because there is no market where this kind of instruments are traded. So instead of giving a misleading information, you can deviate, but there is a rider here. You can deviate from the requirement of Ind AS when such deviation is not prohibited by the regulatory framework. Underline, when such deviation is not prohibited by the regulatory framework, or the regulatory framework allows you to deviate. It is written in the line above the table. So what I have done, I have made a small table for you. In this table you see there are two columns, situation 1 and situation 2. Situation 1 is where regulatory framework does not prohibit deviation, and the second situation is regulatory framework prohibits deviation from the standard. So your institute will ask you, can a company deviate from application of Ind AS? You can't say no, you can't say yes. You can say it can deviate from the application of Ind AS if the management thinks that by observing Ind AS it can be misleading, and the regulatory framework either permits deviation or does not prohibit deviation. Okay, so you'll have more responsibility now. The entity can make the deviation if the law permits, give the disclosure, then you have to also disclose that all other requirement of Ind AS have been complied with, subject to this deviation. And then you have to also give a description of the title of the standard and the accounting treatment required under that standard. So you will say the deviation relates to Ind AS 109, financial instrument, which requires that a derivative product should be valued using fair value. But we are not in a position to calculate the fair value of this particular customized derivative. Then nature of departure, that is how you have deviated, reasons for the departure, okay, why you have departed, and last is what is the financial effect of this departure. So much disclosure you have to give. If you have deviated from application of Ind AS which is permitted by the law, but what if it is not permitted by the law? Will you still deviate? The answer is no. Then you don't have to deviate, come what may. You have to comply with the relevant Ind AS. Okay, but you can give a disclosure of the title of the standard and the nature of requirement. Follow the Ind AS, but give a disclosure about this standard, requirement, and the nature and extent of adjustment required. But that you will give in the notes, not in the financial statement, that had we deviated, this is what the impact would have been, though such adjustment would not be made. So without making adjustment, you just have to give the disclosure. If law does not permit deviation, follow the Ind AS and give the disclosure about the name of the standard, the nature of the requirement, and what adjustment you would have done. You would have done without actually making adjustment in the financial statement. So this is about departure. So there is a summary of presentation of true and fair view and compliance with Ind AS. Financial statement helps us to prepare statement of financial position, that is balance sheet, statement of financial performance, that is profit and loss, and statement of cash flow. Then true and fair requires to select an accounting policies as per Ind AS, to present information that is relevant, reliable, comparable and understandable, and to provide additional disclosure if required. So if you follow all Ind AS and you give all disclosures which are required, then your financial statements are true and fair. Okay. When an entity deviates from the requirement of the standard, then management concludes that the financial statement present a true and fair view. Management compliance with appropriate Ind AS except departure. The title of the standard, nature, treatment, reason, and if it was disclosed, if it will lead to misleading, that also disclose. And for each period presented, the financial effect of departure in each item in financial statement. An entity cannot rectify inappropriate accounting policy either by disclosure of the accounting policy used or by notes on explanatory material. What does that mean? It is not printed? It's printed. By disclosing a wrong accounting policy, you cannot justify a wrong accounting policy. Is it right? Suppose you have followed wrong accounting policy, and if you have made the disclosure, it is not enough. Your financial statements are not Ind AS compliant. Okay? Not printed. You write it down. It is because maybe the alignment was not done properly. So here also the performance word is missing, I think, in your notes. And cash flow of an entity. Just write it down. Certain lines are not printed in the notes. The source of this chart is ICI material. Quick revision one day before the exam, you can have a look at it. I believe you should study everything in detail so that you don't miss out.
Now for MCQs also you have to read about.
Yes, and because you have to handle MCQs, then you have to read in detail also, because any line can be asked. They can raise query on any line. Is it right? So now we'll take a 5 minutes break, and after that we will go to going concern. Okay. Okay, I'll keep the previous slide in break. 5 minutes break. You can relax, and we are going to solve one question also on going concern. Very interesting question. Five minutes break.
यूट्यूब पर करना ही होगा।
नहीं चालू है वो। Okay, we are back. Next point is going concern assumption. This is something which you have learned right from 11th standard accounts. So what is the meaning of going concern assumption? That the entity is going to continue for a foreseeable future. That means there is no intention to wind up the company for at least a period of 1 year or substantially reduce the scale of operations. Then it is a going concern. And if it is a going concern, we are going to apply Ind AS as it is, what we are learning. But if it is not a going concern, then the basis of preparation of financial statement will be different. Then we'll have to change the basis of preparation of financial statement. Then financial statement will not be prepared on a going concern basis. So what happens in that case? The assets are recorded at realizable value and the liabilities are shown at payable value. How much amount you'll have to pay, rather than applying the figures and arriving at the figures as per Ind AS. So one has to check going concern also in certain cases, like for example certain airlines, they have stopped the operations. So whether their financial should be based on going concern or not. An entity is required to make an assessment of its ability to continue as a going concern and prepare the financial statement on a going concern basis. So usually this is what companies do. As long as they don't find any problem with the company, they prepare financial statement on going concern. Sometimes this idea also does not come to their mind also. If you are doing audit of ITC and if you say, sir, have you checked going concern? They will say, next year we will change the auditor. Okay. But if you are doing audit of Jet Airways, you can raise this question. If you are auditing Vodafone Idea, you can raise this question, that whether you will continue or not for next 12 months. If you are auditing Go First or SpiceJet or things like that, so many companies, will not take names because they might feel offended also. Unless the management either intends to liquidate the entity, so management has already made up their mind to liquidate, or cease trading, stops trading on for whatever they were from the business, and next is they have no realistic alternative but to do so. So your business can become illegal. You have started one online gaming company, government has banned online gaming. It is destroying the youth of this country. Instead of putting their time on innovative and productive work, they are making teams on the app and the actual team is not playing. Ban these apps. Okay, business model failed and you have to wind it up. like that, just an example. Or let's say simple example, company machines are designed for diesel cars only, and the government says no more diesel car with effect from this date, and if you have no other realistic alternative to find some other usage of those resources, you will have to wind up. So then in that case you will not prepare financial statement on going concern basis, and you have to give disclosures in the financial statement that what is your basis of accounting, what is the basis on which financial statements are prepared. So you will write that our financial statements are prepared by using realizable value of asset and settlement value or payable value of liabilities. It is not prepared using going concern. And also disclose the reason why the entity is not a going concern. So the applicability of this paragraph is very rare. You will not come across these disclosures in most of the annual reports that you read. Okay, very rare. So how do you make assessment of going concern? When the management is aware of the material uncertainties relating to events or condition that may cause significant doubt upon the entity's ability to continue as a going concern. Management have to look at the uncertainties involved. After some time, there is one example also, that you are manufacturing some product. Till now they enjoyed the protection from the government, that government will not allow import from China, or even if it is imported from China, the duty will be very high, so high that it will make the Chinese product very expensive, and you are flourishing. Then a new government came to power with new policy, no more ban on Chinese product. Is it right? You have entered into some kind of arrangement that we will not put restriction on your product, because if you put restriction on their product, they will also reciprocate, they will put restriction on our product. So globally, over a period of time, the number of restrictions are getting reduced also in lot of areas. Now you have to compete with cheap Chinese product. They are selling at half the price, and you know that now we are not going to survive. Okay, so the change in the government policy eliminating the heavy tariff on Chinese product will cast a significant doubt on the entity's ability to continue as a going concern. Then they are going to disclose such uncertainties. And then that was one example when your company may not be a going concern. So for how many months or year you have to estimate that our entity will wind up after that period? You have to ensure that at least for 12 months from the end of the reporting period, the entity is going to remain a going concern. Then we can follow going concern accounting. One paragraph I have added from my side also. Going concern checklist. You have to check as an auditor or as a management team also whether our entity is a going concern or not. Check the history of profitability and ready access to financial resources. If company does not have history of profitable operation, year after year, they are making losses. Okay, no harm in making losses, but then can you raise the funds to continue the operations? Because if you are making losses, it means your net worth is getting eroded. This Zomato is also making losses. From the incorporation till date, have they made profit? But they are still going concern. They have access to funding. They have raised money by issuing equity share. If yes, it is a going concern. Loss-making company does not mean it is not a going concern, as long as it can prove that it has enough resources to continue. Detailed analysis can be avoided. Next is, if no, the management requires to carry out the detailed analysis. You are making losses. You don't have access to resources like this Jet Airways company or this Vodafone Idea. At least they have got some access. Some other airlines. So then you have to see what is my current and expected profitability, debt repayment schedule, and whether I can have potential refinancing sources. If you audit some big group companies, you will come to see all these lines which I have written here. That helps us to estimate whether it is a going concern or not. Now I have written one line for you. If the entity is not a going concern, then financial statement should be prepared considering life of the asset up to 12 months only. So don't apply depreciation accounting here. Don't look at the useful life. Compare the book value with the realizable value. Okay, and the difference you will transfer to P&L account. Similarly, you have to see how much liability you have to pay on the reporting date now, assuming that company will not continue. So there can be some penalty clause also. All those you will have to consider. An asset like inventory, debtor will be at their realizable value. Don't apply Ind AS 2 now. Don't apply cost or NRV, whichever is lower. You have to record inventory at realizable value, PPE at their recoverable amount or their realizable value, debtors at their recoverable amount. So to keep you busy, we will take one question 2. Source, write down there, source study material. This question was there in your intermediate syllabus also, but you will not remember, or probably you have not done also. So are you there, online student? Are you there? Doesn't seem to be. Anyway, balance sheet. He said yes sir, very good. Balance sheet of a trader on 31st March 2001, 20x1 is given below. Asset side, non-current asset, PPE, current asset, inventory, financial asset, then trade receivable, other asset, cash and cash equivalent. Liability side, equity, share capital, other equity, P&L account, non-current liabilities, 10% loan. Underline, 10% loan means you have to pay interest of 30 on 35,000. Then current liabilities, financial liabilities, trade payable. Additional information, the remaining life of PPE is 5 years. The pattern of use of the asset is even. If the pattern of use of asset is even, what is the depreciation method? Straight line method. The NRV of the PPE is 60,000 rupees on 31st March 2002. Now see, if the entity is a going concern, then depreciation will be equal to, what is the cost or the balance, the balance sheet, 65,000 divided by 5. So in case if it is a going concern, I will apply normal accounting rules. But if it is not going concern, then I will take 65,000, I will keep 60,000 in the balance sheet, and I will transfer 5,000 rupees in the P&L account. So the depreciation in going concern will be 13,000 and non-going concern will be 5,000. Very easy question. If they ask in the exam, first attack this. Okay. The trader purchase and sale amounted to 4 lakh and 5 lakh. That will be same in going concern and non-going concern if you have to prepare statement of profit and loss. Third, the cost and the NRV of the inventory on 31st March 2002 were 32,000 and 40,000 respectively. Reply, If it is going concern,
32,000.
then lower of the two, 32,000. If it is non-going concern, then I'll take 40 in the answer and 40 in the balance sheet, 40 in P&L account also. Employee benefit expense is 4,900, same, no difference in P&L account. Other asset is written off equally over 4 years. Where is other asset? Asset side 10,000. If it is going concern, 10,000 divided by 4. But if it is not going concern, we'll write it off because nothing is given. We will write it off because there is no realizable value of this. So we'll write it off fully if it is not going concern entity. Trade receivable on 31/3/2002 is 25,000, of which 2,000 is doubtful. Collection of another 4,000 depends on successful reinstallation of certain products supplied to the customer. So if it is a going concern, we will only prepare usual provision. But if it is not a going concern, then even this 4,000 rupees is doubtful now. So my total provision for doubtful debt, 2 plus 4, 2,000 I have to provide in any case, and another 4,000 I have to pay because my entity is not a going concern. So I don't know whether this contract can be successfully executed or not. If not executed, your 4,000 rupees cannot be collected. So my total provision for doubtful debt will be 6,000 in non-going concern, and accordingly my balance sheet figure will also change. This is P&L account. In balance sheet, 25 minus 2, 25 minus 6. Next point, cash balance on 31/3/2002 is 37,100 before deduction of interest paid on loan. So this will be same, going concern, non-going concern. Interest is how much? 3,500. So my interest will be deducted from 37,100. How much is that? 37,100 minus 3,500. 3,300. That will appear in balance sheet. And in P&L account, interest will appear. In P&L account, interest will appear because that problem says you have already paid but you have not accounted. So now next is there is an early repayment penalty for loan 2,500. Will you write that in going concern? Will you write that in non-going concern? Yes. And because it is not yet paid, it will appear in the balance sheet also as a liability, because second effect we have to give in balance sheet. So P&L account will have 6,000 rupees financial expense in non-going concern and 3,500 in going concern assumption. Prepare the profit and loss and balance sheet of the trader assuming going and not assuming going concern. Good question for understanding how to prepare financial statement when it is not a going concern. Right, in your book I think I have given you the format. First format is SOPL, second is balance sheet, and there is a small working note for depreciation and amortization under non-going concern basis. So what I'll do, I'll first ask you to read the note given at the end of the answer so that you will understand. Under non-going concern, stock and PPE will be valued at NRV. Do not apply your other Ind AS now. Other Ind AS are applicable if it is a going concern. Under non-going concern, the penalty on loan will also be considered. And third, non-going concern does not affect presentation of financial reporting. Now this was an interesting question from a student. He says that since it is not a going concern, question is very genuine. All items should appear as current asset and current liabilities. But the answer is no. As far as the presentation part is concerned, the classification will remain the same. Okay, classification will continue to be current and non-current. Now first what I'll do, I'll prepare a working note on depreciation under non-going concern. Once you complete that, then preparing P&L account and balance sheet will become very fast. Okay, so right hand side rupees, complete that. There are two assets which we have to depreciate. One is PPE and one is other assets. We don't know what is that other asset, but there is a note for that. So PPE, if it is not going concern, we will simply compare opening book value with the closing realizable value. Opening book value 65,000 and NRV 60. So therefore decline 5,000. This will go to P&L account, and in balance sheet we will present 60,000. Then other asset, if it is not a going concern, there is no realizable value given, will fully amortize 10,000. So total depreciation and amortization, if it is a non-going concern, will be how much? 15,000. Very good. Now I'll first prepare statement of P&L account. Keep that depreciation figure in mind. Other we will write here only. Two columns I have prepared so that you can save time. Start with point A, revenue from operations. Anybody revenue from operation in the adjustment number B? Adjustment 4,50,000. Total is 4,50,000, right? Point number B, expenses. Under that first point, purchase. Adjustment number B. Adjustment number B, 4 lakh. Change in the stock. Wait. Change in the stock will be opening stock minus closing stock. Opening stock is in the opening balance sheet. You will find 30,000. And if it is a going concern, I will take cost or NRV, whichever is lower. So that is 30 minus 32, 2,000 in bracket. Whereas in the next column, I will take 30 minus 40, 10,000 negative. Now do not apply Ind AS 2. Employee benefit expense, we will take same figure, 14,900, adjustment number D. Then financial expense, in first column I will only take interest on loan. You can write in bracket 10% of 35,000, but here I will take 6,000. In addition to 3500, will also take into account the penalty payable on early repayment of the loan. Point number H. Then depreciation and amortization. If it is a going concern, 13,000 on PP, 2,500 on other asset. Yes or no? But if it is a non-going concern, working note 1. What was working note 1? 15,000. Very good. One more, write other expense. Under other expense, write allowance for doubtful debt. Under allowance for doubtful debt, if it is going concern, only take 2,000 rupees. But if it is not going concern, the other 4,000 also becomes doubtful. Collection of 4,000 from other customer also will become doubtful, 6,000. Tell me total B, total of expenses. Student will do it. I will check. 433,900 is right. Second column. 433,900 is right. Anybody for second column? It will be different. 431,900 you are getting? Yes, 431,900. Yes, one student got it. Mr. Rahul Sundar, have you got 431,900? Got it. Very good. So what is the profit in the first column? 16,100. And second column? 18,100. So what you'll do, you will add this profit to the opening profit figure. If you look at the balance sheet, you have profit and loss account 25,000 on the liability side. Is it there? Question book. Plus you have to add this profit. So that will give you closing balance of profit and loss. Understood? In addition to that, this stock will appear 40,000 in the balance sheet. 2,500, this liability is not yet paid, will appear. Then this PP will appear. Here we will deduct 13,000 and 2,500, and here we will deduct as per the working note. Then 2,000 I will deduct from receivable in going concern, and 6,000 I will deduct from debtors in non-going concern. So keeping that in mind, now we'll prepare balance sheet. Write down two columns, going concern, not going concern. Start with asset side. First, non-current asset. Presentation will not change even though it is not a going concern. So PP, anybody, PP, first column. Yes, 65,000 minus 13,000, 52,000. Second column.
60,000.
Second column, 60,000. Current asset. Question in front of you. Inventory, 32. Cost or NRV, whichever is lower. Non-going concern, 40,000. Financial asset. Under the trade receivable, 25,000 minus 2,000. 2,000 allowance for bad debt. 23,000. Next column, 25,000 minus 6,000. 19,000. Other assets. Going concern, 10,000 minus 2,500. 7,500. Non-going concern, 0. Cash and cash equivalent after interest is paid on the loan. In the problem they have given 37,100 minus 3,500. 33,600. The payment for penalty is not yet done, so that will appear in balance sheet as a. So asset side is complete. Can you tell me the total? Sundar Rahul, Ajit Pawar. We have a student Ajit Pawar. Now I am in safe hand. 148,100. Very good. 152,600. Liability side, share capital will be same. Take from the opening balance sheet, 60,000. Other equity, P&L account will change. Add the profit of going concern in the opening profit, 41,100. Anybody second column? 25 plus 18,100. 43,100. Non-current liability, under that write financial liability borrowing. First column same figure, 35,000. And second column I will add the 2,500 also. That is also payable. 37,500. 37,500. Current liabilities, financial liability, trade payable. Will you take the same figure? No. because that will change. You have done purchase, so that will be equal to balancing figure. Question has not given you closing balance of trade payable, and they have given all other figures. So trade payable will be the balancing figure, and you will be happy to note that it will be same in both the columns. Is it right? Is it 12,000 in the next column also?
Yes.
Put the asterisk mark in both places, and therefore your total is 148 100, 152 600. Notes I have already printed in the book. So you write down here important question for 5 marks in the exam. If you have done in advance, you can easily solve in about 5 to 10 minutes. Okay. But if you have not done in advance, you can make mistake. You will have lot of doubts whether I should take inventory in balance sheet at cost or NRV, or whichever is lower. Okay, now we'll come to question number 3 from your study material. When you look at the size of the question, then you will get terrified. But it is in your study material. And nowadays they ask such question also. You are going to prepare financial statement in future. You will have to read lot of documents, contracts. Okay. Life is not going to be easy after qualifying. You have to read more. Entity XYZ is a large manufacturer of plastic product for the local market. Understood? Large manufacturer of plastic product. On 1st April 2006, the newly elected government unexpectedly abolished all import tariffs. Now this kind of situation can make a business a non-going concern also, including the 40% tariff on all imported plastic product. So earlier the plastic product attracted 40% of tariff, which means it will become very expensive. But now that has been abolished, zero tariff. Many other economic reforms implemented by the new government contributed to the value of the country's currency appreciating significantly against most other currency, which means rupee appreciated. If rupee appreciated, what happens because of that? Imports will become cheaper or expensive? Cheaper. On one hand, you have reduced the tariff, that will make the imported product cheaper. Even the rupee has started appreciating, that will also further make it cheaper. And what will happen to your exports? Exports will become expensive for the foreign parties. So your imports in India will increase, but exports from India to other country will decrease because of the appreciation in rupee. Some knowledge of finance got involved here. The currency appreciation severely reduced the competitiveness of the entity's product. So now the foreign products will become more cheaper. It will become cheaper due to two reasons. The tariff was reduced and the currency appreciated. So that makes your product less competitive, non-competitive now. Before 2006, entity XYZ was profitable. However, because it was unable to compete with low priced imports, entity XYZ reported a loss of currency unit 4,000. So So now it has become a loss making from a profit making company. On 31st March 2007, entity XYZ's equity was 1000. It is still positive net worth. Management restructured entity B's operations in the second quarter of 20x7. Entity's business operation. Why B's operation? Entity's business operation in second quarter. So of course, if you have to survive, you have to restructure. This restructuring helped reduce losses for the third and the fourth quarter to 400 and 380 respectively. So what was the loss in the last year? 4000. Now quarterly losses have been reduced significantly, but still it is loss. In January 2007, the local plastic industry and labor union lobbied government to reinstate tariff on the plastic. Lobbying. Have you heard lobbying? Powerful people, they go to the government and they pressurize the government that you have to bring the tariff back, otherwise we will not be able to survive. And when you take labor union also along, they are the vote banks, and the industrialist, they are money bank. So what the government will do? Government sometimes they will listen, because the government wants to remain in power for a long term, and they require money power and voting power both. Don't write in the exam. On 15th March 2007, the government announced that it would reintroduce limited plastic import tariff in 2008. So government will introduce tariff, but limited, means the rate will not be as high as earlier. However, it emphasized that those tariff would not be as protective as the tariff enacted by the previous government. See, they have to maintain relation with other country also. They have to also satisfy the home industrialist and labor union also. Very difficult task for a government. In the latest economic forecast, the government predicts a stable currency exchange rate in the short term. So now they are saying, don't worry, rupee will remain stable. At least the loss you are suffering because of rupee appreciation will not be there, with a gradual weakening of the jurisdiction currency in the longer term. And they are also assuring you that rupee will depreciate in the long run. So it won't appreciate anymore, become stable for some time and start depreciating. So if rupee start depreciating, good news for the exporter, but bad news for the importer. So import will become expensive. So government will introduce tariff, import will become expensive. Rupee will depreciate, export will become more expensive. So some hopes have arisen now. Management of XYZ undertook a going concern assessment on 31st March 2007. Very good, because there is a lot of uncertainty involved here because of reduction in tariff, rupee appreciating. So they have to sit down and check whether can we survive for 12 months. Management projects or forecast that imposition of a 10% tariff on the import of plastic product would, at current exchange rate, result in entity XYZ returning into profitability. Wow, good days will come. If the government imposes 10% tariff and if the exchange rate remains stable, we will be back to profitability. How should the management of entity XYZ disclose the information about the going concern assessment in entity's financial statement for 31st March 7? So first question that will come in your mind, whether the entity is a going concern or a non-going concern. Will it present financial statement as a going concern or as a non-going concern? It will present it as a going concern. because from the facts given, after restructuring their losses have declined. After lobbying with the government will impose tariffs, exchange rate will become stable, the company will run into profit. So there is no need to liquidate the operation in next 12 months. Okay, there is no situation. It has an alternative to continue also. It is hoping that it will get profitable. Net worth is also positive. So first of all, the financial statement for 31st March 7 will be on going concern basis. But you have to give a disclosure about uncertainties involved in the notes to account. That disclosure will be given so that the user should be made aware that this company has got some uncertainty, but that uncertainty is not so severe that it has to wind up. Okay, so you will read the answer in the notes given to you. Will you read? Yes, and you make your own summary out of it. Okay. This way you have to draft your notes also in the notes to account in future. Basis of preparation. On the basis of management assessment, the financial statement have been prepared on the going concern basis. Most management will not call their organization as non-going concern, especially in such simple situation when the government has also agreed to their demands. However, management's assessment assumes that the government will reintroduce the limited plastic import tariff and the currency will remain stable. On 15th March 7, the government announced that limited import tariff will be imposed in 2008. So, however, the government emphasized that tariff would not be as protective as 40% in effect before 2007, provided that CU does not strengthen. CU means currency unit, which in India is rupee. Management projects that 10% tariff would return the entity to profitability, plus they also have a net asset of 1000. If import tariffs are not imposed, currency remains stable, entity XYZ liability could exceed its asset by the end of third quarter of 2008. But at the same time, they have also mentioned, suppose government does not impose tariff, because government is ultimately government, is it right? They can change their stand anytime. And suppose the projection about exchange rate also is not coming to be true, then the entity might have negative net worth by the end of third quarter. This is called estimated amount. So on the basis of this assessment, management believes that entity XYZ is a going concern. So at least for 12 months there is no need to wind up the operations. So that was a very well drafted answer. Next is accrual basis of accounting. On this I have not written much. Financial statements have to be prepared on accrual basis except the cash flow statement, that is prepared on receipt and payment basis. It means you will recognize asset, liability, income, expense as and when they occur. Income is recognized when you have the right to receive it, when you have earned it, and expenses are recognized when you have incurred it, you have an obligation, irrespective of the timing of payment. That is called accrual method. Match should be made between income and expense based on the period. So the purpose of accrual method is that income is recognized when they are earned, expense is recognized when they are incurred. So it helps in matching of income and expense in the statement of profit and loss. Otherwise, suppose you purchase in this year and you made the payment, so purchase will get recorded. Sold in this year but collected in next year. So if you follow cash method in P&L account, next year that revenue will appear, so mismatch can be there. Anyway, that accrual method is very easy and you don't get question on that. You are so big qualified people for all this adjustment. Materiality and aggregation. What do you mean by materiality? Already discussed. Okay, so I am not going to repeat materiality. Yes or no? Only one line I had not read earlier. Even the schedule 3 gives you a materiality limit, which is 1% of turnover or rupees 10 lakh, whichever is higher. About materiality we have discussed in the starting part. Can we go to the next part? Offsetting. What is offsetting? Suppose you have bank loan from Dena Bank and you have a fixed deposit, bank loan taken from Dena Bank and fixed deposit from Yes Bank, fixed deposit in Yes Bank. So this is a liability, this is an asset, this is 100 crore, this is 30 crore. Can I show net loan 70 crore in the balance sheet? So there is a standard here, Ind AS 32, which will guide you when should financial asset and financial liability be netted off. Is it right? In schedule 3 we have seen, suppose you have deferred tax liability, deferred tax asset. If they arise under same governing tax law, okay, then they can be netted off. That is called, they can be offset in the balance sheet. Similarly, in the P&L account, you sold machine 10,000 rupees, you incurred 200 rupees commission to complete the sale of machine. Will you present 10,000 and 200 separately for presentation, or will you present 9,800? So in this case the two transaction represents in substance one. So one has to look at the substance of the transaction, whether netting off will give proper information or separate information will give more proper information to the user. Okay. Now suppose you are a railway ticket agent, example. Okay, you will find a lot of people doing railway ticket booking because not everybody can use the computers. So they take 1,000 rupees from the customer, the ticket amount, and they also take 300 rupees as booking charges, their commission or service charge. Total amount they receive from the customer is 1,300 rupees. So how much amount they are going to present in their profitability statement? 1,300 they receive from the customer, but 1,000 they pay to the railway. So effectively their earning is only 300 rupees. So they will show only that net 300 rupees as income in the profit and loss account. Okay. So one has to be very careful about setting of the item in the balance sheet and P&L account, because one has to see whether separate information is more useful or netting off can be more useful. Sometimes netting is allowed by the standard, like deferred tax asset and liability. In provision standard, provision and related reimbursement can be netted off in the P&L account. If you are selling a television and giving warranty, you will make provision for warranty, but your manufacturing company says we will reimburse you that expense. So in P&L account I will only put the net amount that is allowed by the standard on provisions. So offsetting means item of asset, liability, income, expense are offset against each other. Underline, such an offsetting reflects the substance of the transaction and is required or permitted by an Ind AS. Substance of over the form one is to see. Example of that railway agent. In substance, his income is only 300 rupees, not 1300. And that is given in Ind AS 115 also, revenue standard. Some example of what can be netted off. Like for example, if you are selling a PPE item and you incur some sale expenses, commission, brokerage, net off. Then in P&L account, I can net off the foreign exchange gain against foreign exchange loss. In P&L account, I can show sales minus sales return, purchase minus purchase return, provision and its related expense. Gain and loss on sale of PP, we can net off. On one machine there is a loss, on one machine there is a gain. Then gain or loss on sale of investment, you can show net amount. And what you cannot net off is where there is a specific requirement of separate disclosure. Like you have seen in schedule 3, is it printed in the book? Yes. What cannot be netted off? Just write this heading there. This line is missing for some unknown reason. Trade receivable less allowance for bad debt. This we present separately, both lines. Okay, because requirement of the standard. Measuring asset net of valuation allowance such as obsolete allowance on inventory is not offsetting. Then one interesting example, rent paid to one party, rent received from another party. So just because it is rent, you can't write net amount and it will not be netted. There is one good question also, not this one, after some time. This is easy. Question number 4. You will write the answer in notebook. XY Limited sold an item of PP, selling price 100, cost 85, accumulated depreciation 15 and selling expenses 2 million. Gain on sale of PP gross is 30 million. How this 30 million has come? Any guesswork? This is your cost minus accumulated depreciation is 70. 100 is selling price, book value 70, so 30 is profit, but you have also incurred 2 million as expense. Now the question is, will you show profit on sale of PP 30 million and on the expense side, selling expense relating to PP 2 million, 30 gain, 22 loss expense, or will you show 28 gain on sale of PP? Should the company present gain and selling expense separately? So now here the substance of the transaction is all these are one transaction only taken together. So the correct answer will be we should only reflect 28 profit on sale of PPE. So write down just 1 or 2 lines, 1 line only. This is a concept question taken from reference book, just to fill some gap between institute material and the concept. So write down 1 line only. Gain on sale of PP. This can come as a part of a bigger problem where 4 or 5 items will be given and you have to answer which of them can be netted off and which of them cannot be netted off. Okay. Recently I have seen they are asking question for 5 mark which has 5 parts. So that helps you to test the concept of the student. Instead of giving long lengthy question, give them concept like this one. If you know the concept, you will write 28. If you don't know, then your own SAIS, Student Accounting Standard in India. Okay.
Now they can ask this as MCQ also.
Yes, anything can be converted into an MCQ also. They will say profit recognized 30 million, 28 million, 100 million. Somebody will write sale value also. So whatever you will imagine, they will put some option there. Okay, one more question, number 5. During 1920, X Limited created a provision for warranty claim of rupees 5 million under Ind AS 37. So warranty claim created is 5 million. Reimbursement as per Ind AS 37 is rupees 2 million. Now this question will come again in Ind AS 37. Should the entity present warranty expense of 5 million as an item of expense and related reimbursement as a separate item of income? Now this question you have done in AS 29 also, hence I have put it here so that I can ask you that query. Should we show income and expense separately or should we show net provision? So Ind AS 37 also says you can show provision net of reimbursement because it is related to the same warranty. Now if you have not understood the question, companies which sell electronic goods, electrical goods, this AC, okay, or this fan or computer, they give you 1 year, 2 year, 3 year warranty. But he is just a dealer. If there is a manufacturing defect, the customer will catch hold of whom? Dealer. Company is in Japan, Sony. Okay, you will not go to Japan to catch hold of the company. He will go to the dealer. What is this product? Nonsense, idiot, and some other Hindi abuses. Okay, and you will say, sorry, I'll replace. But why will you bear that loss? So usually the company says you handle the customer and in a year or monthly, quarterly, they settle those warranty expense. You will get reimbursement. So you can put it net amount because it is substance is that it is 1. So the answer, write down 1 line. Again, such questions can be a part of a bigger question or an MCQs. It shall present warranty provision. It shall present warranty provision net of reimbursement as per Ind AS 1 and Ind AS 37. Because as a user of financial statement, I am interested in how much is the cost of offering warranty, net of expense. Okay, noted? Okay, now one big question number 6 is appearing. Good question, write down good question. And they should ask such question for 2 marks. Is offsetting of revenue against expense permissible in case of a company acting as an agent and having sub-agents where commission is paid to sub-agents from the commission received as an agent? Okay, so first there is a company. Your company has appointed an agent and agent has appointed sub-agent. Company will pay commission to agent. Like it happens when you say book a cab, private cabs. There are a lot of agencies involved. He will say, yes sir, I will deliver you the car. This person says, he does not have any car. Huh? He will call his main agent and the main agent will call the company owning car that we have got a customer. So he will get a commission of 2000 here and he pays a commission of 500 rupees to this sub-agent. So the question is how this company report its income and expense. Whether 2000 rupees will be shown separately and 500 will be shown separately or 1500 rupees net commission income will be shown separately. Why?
This is not one transaction.
This is not one transaction. So in substance there are 2 very different transactions. 2 different operational activity you are doing. One is you are dealing with your subcontractor where you are like a principal, and second you are an agent to the main company. Amount is receivable and payable to different parties, different contracts you have entered with two parties. So in substance it will be better because your business model is you get commission, that is your income, and you incur expense to generate that commission. So I believe that this kind of situation will result into showing commission income and commission expense separately because that is your business model. So see the answer in the book where I have highlighted the important line below. Net presentation in the given case would not be appropriate as it would not reflect substance of the transaction and would detract from the ability of the users to understand the transaction. The commission received by the company as an agent is the gross revenue of the company, and the commission paid by it to sub-agent would be considered as an expense and should not be offset against commission earned by it, because in substance those are two different transactions. One more question I will discuss, answer is printed. Is offsetting permitted under the following circumstances? Expense incurred by a holding company on behalf of subsidiary. Expense incurred by a holding company on behalf of a subsidiary, question 7, which is reimbursed by the subsidiary, whether in the separate books of holding company, the expenditure and the related reimbursement of expenses can be offset. So usually the answer would be yes. Based on the information given, usually if they are related to one transaction only, then first you incur the expense and then it is reimbursed by the subsidiary. So if it is the expense of the subsidiary, okay, which you are first incurring and then they are reimbursing, then in substance it is one. So only the net amount will be presented. So one has to look at the contract between the two and the substance of the transaction, and then accordingly one can take a decision. So answer is as per para 33 of Ind AS 1, offsetting is permitted, underline, only when the offsetting reflects the substance of the transaction. So first thing you have to see whether any agreement between holding and subsidiary company needs to be considered. If the agreement is to reimburse the cost incurred by the holding company on behalf of subsidiary company, like that earlier example of Ind AS 37, that you first incur the expense and then I will reimburse you, then the same may be presented net, and it should be ensured that substance of the arrangement is that the payments are actually in the nature of reimbursement. So usually, as I said, they can be netted off. Question number 8, whether profit on sale of an asset against loss on sale of other asset can be offset. So usually the answer would be we present the profit or loss on sale of asset as net item in the statement of profit and loss. If you look at any company's profit and loss, there is only one line item, profit on sale of asset, but it may be net of some asset which have losses also. But of course, if the nature of the transactions are very different, then ideally they should be shown separately. Okay, so if you have sold 5 cars, 3 of them resulted into gain, 2 of them resulted into loss, you can put it as one transaction. But if you have sold a car at a profit, land at a loss, car at a profit, land at a loss, then maybe it is better to present separately. Ind AS 1, write down the answer. Ind AS 1, in between I have to make you write so that you are also involved. That is how the notes are designed. Okay, Ind AS 1 requires an entity to present on a net basis gains and losses arising from a group of similar transactions accordingly gain or losses arising on disposal of various items of PPE shall be presented on net basis. Of course, sometimes judgment can be required. Sale of car and sale of land, although they are part of PP, but management may decide to show it separately. That you can do. But sale of Maruti car on profit, sale of Indigo loss, that you can't do. Don't give too much of information. Again, as we discussed in the earlier part, it will obscure the information. Sale of Zen, sale of Mercedes, then color wise also you can give detail, size wise also. So I have written one last punch line. However, gain or loss should be presented separately if they are material. However, the gain or loss should be presented separately if they are material. So in the exam, give reference of the standard. No need to write paragraph number. Nobody remembers, nobody expects also. Then write the concept and write the conclusion. That is how the theory questions are required to be structured in the answer. Usually 3 parts. First part, to which standard, which provision of the law it is related, then analyze, and then conclusion. Okay, one more question, number 9. Can you do it as homework, question 9? Yes, 9 number, you please try yourself. Question next is, concept is frequency of reporting. That means what should be the gap between your 2 financial statements. So they are saying a complete set of financial statements should be presented at least annually. In India, annually means financial year 1st April to 31st March. In international accounting standard, there are 2 choices. Either it can be annually or 52 weeks. Is it possible to have a gap of more than or less than 12 months? Sometime it is possible. If a company was suppose incorporated on 1st June, then the first year will have only 10 months. Or some company might change their year ending date also. Like a company was falling 31st December, it may shift to 31st March. So in that year it might have a 15 months statement of profit and loss. So if the time gap between 2 periods other than for interim reporting is reporting for a period less than 12 months. Like in India, listed company prepares quarterly reports. If the time gap is shorter or longer than annual period, entity will disclose the reason for adopting a longer or a shorter period. Okay, and also mention, suppose you are giving comparative also. So previous year was based on 12 months, previous comparative, but this year is 15 months, then you please mention that amounts are not exactly comparable. Otherwise somebody will think, how suddenly the profit has jumped 25%. and that is because it is 15 months P&L account, that was 12 months. So please clarify. Then what about comparative information? At least one comparative statement you have to give. How much? At least one. Okay. At least one comparative information you have to give in. Comparative information shall be presented in respect of previous period for all the amount reported in the financial statement of the current period. So you will prepare a comparative balance sheet. Minimum one you have to give for the previous period. Comparative P&L account, comparative cash flow statement. Even in the notes, the comparative figures are given. That is what you had reported in the earlier period, and that is minimum. The financial statement will comprise of minimum 2 periods, except the year in which you are incorporated. First is for current period, and second is at least one comparative previous period. Can I give more than one comparative previous period? The answer is yes. You can. It's written minimum. This is, of course, you have to give, and at least one comparative. But you will not find any generous company which will give more than one comparative. Only that additional balance sheet is given if either you are preparing Ind AS financial statement for the first time, there is a retrospective application of accounting policy, or there is a retrospective adjustment for prior period items. Next line. Comparative information for prior period is also required in the notes that I have told you. Additional balance sheet. Additional balance sheet at the beginning of the earliest comparative period. So let us say my current year date is 31st March 24. Comparative will be 31st March 23, and the beginning of the earliest comparative period will be 1/4/22. This additional balance sheet is required only when, remember for your interview question and exam question, when there is a application of accounting policy from retrospective effect, or underline the word retrospective, to make a retrospective restatement of item in the financial statement. PP was wrongly calculated, inventory was wrongly calculated, or when an entity reclassifies an item, investment property was wrongly put in PP item. Is it right? FVTPL was wrongly put as FVT OCI item. Non-financial asset under financial asset, for example. Like that. So if you find that, oh, my presentation is wrong, then you have to go to that year in which the mistake was made, and you have to change the presentation from that year, and you have to give additional balance sheet. So now you don't have to adjust the current year P&L account for the past mistake. You have to prepare one additional balance sheet and check what would have been the balance had I done the accounting correctly in that earlier year. Okay. The entity will prepare additional balance sheet. So this is a possible question: when is additional balance sheet required to be presented? You will be able to answer? Okay. Now what happens when an entity changes the presentation or classification of item in the financial statement? Now this is not error, but they have changed the presentation or classification. Then what will I do? No, not retrospectively, because it's not an error. We have to only change the comparative. Regrouping will be done for comparative period also. Regrouping will be done for comparative period also. So comparative information are also reclassified, and the nature, amount and the reason of reclassification are disclosed. So sometime you will have to change the comparative information, regroup in the same way so that previous year and current year can be compared, and then you could disclose the nature, amount and the reason for that reclassification. When reclassification is not impracticable. So now comes the impracticability. Why impracticability? Because many times we don't have the data to compute from for the previous period. Okay, we don't have resource, we don't have data. So whatever is the reason, you have to give the disclose the reason for not reclassifying the amount and the nature of adjustment that would have been made if the amount had been reclassified. So what adjustment you would have made? So we'll take one more question today. Question number 10. A retail chain acquired a competitor in March 20x1 and accounted for this as business combination under Ind AS 103 on a provisional basis in the March 31st 2001 annual financial statement. So there is a business acquisition and you have done accounting on provisional basis. What is provisional basis? Ind AS 103 says assets and liabilities acquired will be recorded at fair value, but calculation of fair value in a short period may not be possible. Is it right? If you acquire a big company which has got hundreds of assets in different parts of this world and so many receivables, so many financial assets, so they say at least for preparation of financial statement, what you can do? Take provisional figure and then within 12 months you find the fair value. You are given 12 months time. I will explain that in 103 again later. The business combination accounting was finalized in 2001-2 and the provisional fair values were updated. So what they did, within 12 months they found the proper fair values and they updated it. So what will happen now? As a result, 2000-2001 comparatives were adjusted in this year, because last year was provisional, this year is properly calculated as per fair value method. Does the restatement require an opening statement of financial position? That means whether I need to prepare one more additional balance sheet. The answer is there is no error. It is permitted by Ind AS 103 to take provisional figure. So therefore you can restate the comparative, but there is no need to prepare additional balance sheet. So answer is one line. Additional statement of financial position means balance sheet is not required because the acquisition had no impact on the entity's financial position on 1st April 20x0. One more reason for not preparing additional balance sheet in this problem is, suppose my year ending date is 31st March x2, previous year is 31st March x1 and the opening date is 1/4/x0. Okay. Now you will prepare this financial statement also if it is going to get affected. If I have acquired a company after 1st April, in any case this balance sheet is not going to be affected. So additional balance sheet is required only if it is going to get affected. But suppose even if it was not there, then also the answer is you don't have to prepare additional balance sheet. You have to only regroup, reclassify the comparative information. Is it right? So now we'll continue on Monday. Thank you very much. See you. Bye bye.